the modern investor has a strange insecurity. If a strategy does not require 12 screens, 3 Telegram groups, and a blood pressure monitor, we suspect it is not serious enough. Graham's defensive investor is the opposite. This investor is not lazy. This investor is honest. The defensive investor says, I want safety, simplicity, and freedom from constant concern. I do not want my portfolio to become a second full-time job with worse snacks. This is an educational book summary episode from The Intelligent Investor by Benjamin Graham. Today we are using the defensive investor framework to show why boring can be a real strategy. In The Intelligent Investor, Graham argues that the return an investor should seek depends less on the amount of risk he wants to take and more on the amount of intelligent effort he can bring. That is a powerful distinction. More return is not earned by wanting more excitement. More return, if it comes at all, must be earned by more skill, more work, and more discipline. For the defensive investor, Graham's structure has 3 pillars. First, allocation. Graham discusses a portfolio divided between high-grade bonds and high-grade common stocks. His classic stock range is not less than 25% and not more than 75%, with a simple 50-50 reference point. The exact number is not the main lesson for every modern investor. The main lesson is that the allocation rule must exist before the market starts shouting. Second, diversification. Graham does not want the defensive investor depending on one brilliant guess. A diversified list of sound holdings reduces the damage from being wrong about any single security. This is not glamorous. That is the point. Defensive investing should not need heroics. Third, rebalancing behavior. When stocks rise enough to push the portfolio above the chosen range, the investor trims back toward the rule. When stocks fall enough to push the stock component below the rule, the investor adds back toward the rule. This is not market forecasting. It is a system that gently forces the investor to do the emotionally difficult thing. The case study here is not a specific stock. It is the investor's behavior during a broad market fall. Imagine an investor who has no allocation rule. Prices fall, headlines get dramatic, and every red day feels like evidence that something must be done. Now imagine another investor with a written allocation band. That investor may still feel uncomfortable, because being human was not cancelled by spreadsheets. But the decision is already partly made. The rule carries some of the emotional weight. Graham's defensive approach also explains why simple funds can be appropriate for people who do not want to select individual stocks. Jason Zweig's commentary notes that modern defensive investors can often get broad exposure through low-cost index-style vehicles. That is category-level education, not a product recommendation. The principle is simple: if you cannot or will not do security analysis, do not pretend otherwise. The checklist item: write your allocation rule when you are calm. Not during a crash. Not after a rally. Write the stock range, the safer asset range, the rebalancing trigger, and the maximum decision frequency. Then keep that note somewhere boring and easy to find. In the next episode, Graham introduces the market's most dramatic character, Mr. Market, the business partner who arrives every day with a new mood and a new price. Thanks for listening. If this episode helped you see that a quiet allocation rule can protect you from noisy decisions, that is the real goal. Until then, eat something that did not come from a packet, sit like your back has a future, and maybe reply to one old friend. Life admin also compounds, unfortunately.